So what a week it has been. We have seen some crazy things happen in the crypto markets, and as a crypto creator, I thought it would be irresponsible not to at least cover this and detail what our options are moving forward as a crypto community. Before I start, I would like to say I hope that no one has been too adversely affected by this whole situation. This was something that could not have been foreseen by the outsider and certainly not the retail investor. So today we'll be looking at life after FTX. What is next? What you can potentially do to protect yourself, and what I will personally be doing. We'll be going through some beginner-friendly content because there's going to be a lot of people who are coming out of centralized finance. They're just disillusioned. But for you people who voted for advanced content, I will be having something for you as well towards the tail end of this video. So let's jump right into it. So first of all, we all know what happened. FTX has now declared bankruptcy, and this is both FTX International and FTX.US. There have been allegations of misuse of customer funds, insolvency, and apparently a close to $10 billion hole, which prompted the deal between FTX and Binance to ultimately fall through. This week, we've also had some insight into FTX internal workings, which showed quite a bit of conflict of interest, to say the least. However, today, what we're going to be talking about is how to move forward from this, what is going to happen next, and how to protect yourself. So let's first have a look at some of the lessons and then move on to some of the potential options that we might have. First of all, let's have a look at the lessons. First, personality cult. So this has been a running theme since May's collapse of Terra Luna. We saw that there was just a lot of presence by Do Kwon on Twitter and basically saying, okay, we are deploying more capital, we are going to defend the peg, and so on and so forth. And then this whole FTX thing, the SBF thing, there was also this huge personality cult almost, in which people believed that this SBF empire was too big to fail. You know, he was the golden boy of crypto, as termed by some media outlets. So when we start to see this kind of personality cult pattern start to form, I think we can all agree at this point that that might be a red flag. There were reports about VCs investing in FTX and Alameda just because they seemed to be credible without actually doing rigorous due diligence. So there's that lesson to be learned. The second thing is that not your keys, not your crypto. So most recently, FTX actually started pausing withdrawals, and so did BlockFi. And this is kind of a similar narrative to what happened earlier in the whole Celsius debacle, where people were unable to withdraw their funds from Celsius because they have again been misusing customer funds. So not your keys, not your crypto. When you send your crypto to an exchange, they are holding it. They're supposed to, in ethical cases, back that one-to-one and not touch it. They're supposed to be a good faith custodian. However, in this case, it appears that this has not happened. And human greed is human greed. A person who made quick billions through trading is going to likely have the tendency to do the same. So why we'll trust them with our crypto seems to be a bit disingenuous in hindsight. The third lesson that we can learn from this whole situation is that centralized finance, or CeFi, broke. But interestingly, DeFi didn't. This time around, if you look at all of the DeFi-based stablecoins, for instance, none of them lost their peg. Everything was running properly. Exchanges were still functioning on all your favorite chains. So basically, these are some quick thoughts that I had when looking at this whole saga play out. Now let's have a look at some of your options moving forward, because this is likely to be the most important thing that we all should consider. The options are, firstly, move your funds to another centralized exchange. Second on the list, we have the option to retreat back to fiat. And third on the list, we have the self-custody option, which a lot of DeFi and Bitcoin maximalists have been talking about, and we will be explaining that in a beginner-friendly way on how to do this in this video as well. So first option, going to another centralized exchange like Binance or Crypto.com. The question then arises, how can we trust them? Now, a lot of these exchanges have gone ahead and published their so-called proof of reserves as well as their cold wallet addresses. So we've seen Crypto.com do this, we've seen Binance do this, and we're seeing basically every other big exchange doing this in order to regain user trust. But then again, this is the whole issue around this. How do we actually trust them beyond these published reserves? Well, we can't really, because they can potentially be exposed, for instance, to FTX or some other contaminated entity and not disclose it to you until it's too late. Audits might, of course, get out of date, though this is likely to be fixed with new Merkle tree-proof solutions, as well as Chainlink's new proof of reserve service, as we've seen them announce. So another centralized exchange doesn't seem like too attractive an option unless we're going to be diversifying our funds across multiple different exchanges in order to kind of mitigate the risk of one going down. Now moving on to the second option, going back to fiat. Now Now, this has, of course, been attractive to a lot of people who are just so scared right now in the markets and are like, okay, I'm giving up on crypto altogether. I'm going back to the fiat world where at least I know I will be insured up to a certain amount on my bank deposits. However, you have to wonder the same thing. Going back to the earlier lesson, CeFi failed, DeFi didn't. In this case, it was all back down to human greed, the same thing that happened in 2008 in the banking crisis. Now, I hate to go into this whole conspiracy theory narrative, but there is this saying going around from the World Economic Forum saying that you will own nothing and be happy. But now when you see all these failings start to come together, it's difficult not to see a connection between all these events. We've seen governments trying to launch CBDCs, central bank digital currencies, that can be turned on and turned off at will by a centralized authority. And then we also have some issues brewing in the traditional finance world. Earlier on this year, we saw Credit Suisse credit default swap rates go through the roof, indicating much higher default risk perceived by the market. And over here, even Jefferies has indicated that Credit Suisse may actually face an 8 billion capital hole by 2024. And that is kind of similar in size to what we're seeing here with FTX, or 8 to 10 billion. And yes, they might be a bigger institution, they might be bailed out, but the end of the day is, what is stopping governments one day from saying, we're not going to bail you out, you're just going to have to switch all your depositors over to the CBDC, and now we can turn it on and off. And even though this goes into conspiracy territory and is a tail risk that is less likely to happen, this might not age well. As people in crypto, we want nothing of that. So going back to fiat doesn't solve the problem of being exposed to mismanagement by centralized entities, and actually even puts more power into the hands of centralized entities who might not have your best interests in mind. So back to fiat, or 100% fiat, doesn't seem like an option either. So here's the third option, self-custody and still being somewhat exposed to this decentralized finance space. Now, of course, I'm not saying that you should move all your assets into self-custody, but personally, I'm keeping at least a bit of my net worth this way in order to hedge against a potential larger crisis. So self-custody, how does one actually do that? So if you're a beginner here and have only just clicked on this video to understand what to do and what to make of this whole situation, well, the first thing that you can do if you want to pull your funds off of an exchange would be to download and set up a crypto wallet. Now, this wallet is something that you hold the keys to on your own, so no one can technically take it away from you, short of things like sanctions and not allowing you to spend it or redeem it for, say, USDC. First of all, you want to learn about the wallet called MetaMask. This is a browser-based wallet that allows you to interact with many Ethereum-based chains. So I have it set up over here. Now, as you can see, if you hold Ethereum, if you hold Matic, if you hold CRO coin, if you hold Binance coin, you can withdraw it to a MetaMask wallet. You just have to set up the appropriate network. Now, for step-by-step guides, that will be covered in a separate video if there's demand for it. However, all you need to know is you will be able to transfer your coins to this one address, this 0x address of yours, across multiple different chains and store all your crypto assets on your own wallet. For an extra step of security, you might want to go ahead and get yourself a hardware wallet such as a ledger, because this will help you keep your keys offline and out of the reach of potential exploiters. Now, if you're investing in Cardano, the equivalent would be to download the Flint wallet, set it up, and transfer your assets to your Cardano address. And the same thing can be said for Atom or Cosmos-based tokens. Download the Kepler wallet, which is the equivalent of MetaMask, and transfer your Atom tokens off to your Kepler wallet. So that is the idea of self-custody. You are taking back your assets, putting it into your wallet, and no one central entity can stop you from withdrawing your funds, moving them across different chains, or sending them to someone else. Now, if you hold a lot of small cap tokens like Shiba Inu, for instance, a lot of these are Ethereum-based or ERC20 tokens, so they should function perfectly well with MetaMask. However, if you're owning something like Dogecoin, you might want to get a dedicated wallet of your own. The Ledger hardware wallet does support all your other favorite coins like Bitcoin, Ripple, Dogecoin, Tether, so this is something that you might want to invest in if you have a large sum that you're going to look to self-custody. Now, this has all been some really beginner level content, and for those of you who are longtime viewers of this channel, you're probably more advanced users than that, and to you guys, I do have some content for you all. And this has to do with minimizing your exposure to individual centralized entities. As we all know, diversification is always a good thing for good risk management, and in this case, we can actually even diversify the layer ones or networks that we're exposed to in order to kind of temper the risk of our exposures to centralized entities. For instance, you might want to diversify across Kronos and Binance chain if you don't want to have the redemption of your coins on either of these chains be completely dependent on one exchange alone. Alternatively, you might also want to to go over to look at Circle's page, Circle being a centralized entity, to see which chains they are actually backing and allowing redemptions of USDC from. You might not want to have all your assets on just these chains listed over here, because Circle might of course be exposed to another centralized entity that might fail. Third of all, you might want to consider things like decentralized and over-collateralized stablecoins, which have actually survived this whole saga. The examples of this include TDAO's My stablecoin as well as MIM. So looking at My as an example, they're still pretty much on peg at 0.994. We do see, for instance, you can go ahead and create a vault to mint some new stablecoins. So these stablecoins are backed by crypto assets at an over-collateralized state, meaning that this underlying crypto can always be liquidated in order to pay out the supposed value of one My stablecoin, which is $1. Now, therefore, this functions as a good proof of reserves or over-collateralization behind your stablecoin, and is thus a way for you to diversify your stablecoin holdings if that is indeed what you want to do, and slowly dollar cost average back into crypto when the bottom is in. So all in all, I would say for the beginners, consider self-custody, and for the advanced users, you might want to start to diversify your holdings across different chains and different stablecoins, bearing in mind the entity backing each asset. So all in all, I hope you found this video informative and useful. If you liked it, do leave a like down below and consider subscribing to this channel. Helps out the channel a lot. If you want to see more such content, we come out with this content on a regular basis, so do stay tuned for more. With that being said, thanks for watching, and I will see you in the